All right, so it's about 5 after. So everyone that's here early, congratulations. Thank you very much for coming. This is Multifamily Passive Cash Flow for Life. We're a meetup. We started about 2 years ago. Nicole Amundsen, my partner, and I started about 2 years ago. We've been teaching, Nicole's been teaching for about 10 years. And then her and I partnered up about 5 years ago and developed the class. And ever since, we've been partners, and we put this together really as an opportunity for students to get together. Like we used to have it at Houlihan's, grab a table, people can sit around, network a little bit, talk with each other, learn a little bit from each other, and hopefully some partnerships will come out of that, which did. And here we are 2 years later, and we've got almost 1,500 people. So I don't know what happened, but it just keeps growing, which is a good thing. Hopefully we're offering value to you guys, and you guys are enjoying that. Hopefully that's why we're growing. So a little bit about, I guess, Brandi, and then what I'll do is I actually wrote this stuff down. So I look down, I'm not looking at you guys, I apologize, but just so you know, so Brandi is an expert in multifamily lending, and she speaks nationally. So we're very lucky to have her. I actually met her at a national event about, was it a year ago? Maybe a year and a half ago?
Maybe so, maybe about a year and a half. It's like COVID has me.
Yeah, I know. It's crazy. So, so anyway, I know you're busy, with everything that you're doing. Obviously, your main business, multifamily financing, and then obviously being asked to speak at different venues across the country, and now obviously over Zoom. So less travel for you, which I guess is good. But thank you so much. We're looking forward to hearing you speak. So let me give a little background on Brandi for those of you that have not had a chance to meet her or know of her. Brandi Shotwell is a principal at Reno Capital Management in Dallas, Texas, concentrating on debt and equity. With over 20 years experience in finance and real estate, Brandi has had leadership involvement in over $1 billion, that's with a B, not an M, $1 billion in real estate projects ranging from commercial acquisitions to commercial development. She's organized funding acquisitions and development opportunities for multifamily investors, high net worth individuals, municipal growth areas, and manufacturing clients. So prior to joining RCM, Brandi was vice president at Edge Capital Markets in Dallas, Texas. And prior to that, she was vice president of Coronado Bay Capital, where she was the top producing originator. She attended Purdue University, I think, what are they, the Boilermakers? Is that right? Go Boilermakers. All right. Where she studied business and marketing. So what we're going to do, obviously, we're talking about multifamily financing. Brandi's going to talk about a lot of different things. But a couple of things might be what to look for in a lender, and then what banks and lenders are generally looking at from you. So how to put your best foot forward. Banks want your business, so it's a two-way street. But on the other hand, they also need to get the material from you that they can evaluate and underwrite your property properly. What you might need, maybe in terms of paperwork. I don't know if you'll cover that or not. And then obviously the question on everyone's mind, what is happening in the lending world with COVID-19? And then we'll do some Q&A. And then after that, we will do some virtual networking. So, Brandi, I think you have your slide deck, correct?
Yes, I do.
Ready? All right, you're in control.
This is the first time I've shared my screen, so you got to tell me if you can see it or not. But James, thank you so much for having me. I do want to say that it's truly an honor to be here. Let's see. I think this is it. Okay.
Yep, you see it.
Okay, so if I go full screen, can you still see it?
Yep, absolutely. Looks great.
Okay, all right. So this is just a slideshow I made to kind of cover everything that investors want to know. Even if you've done your first deal already, it's still good to know kind of the ins and outs of it. But I'll go through it. And then at the end, of course, I'll answer any questions you have. We already covered who I am, who we are. We'll talk about that, but I want to jump right into it. So here we are. So the first slide is, what is a commercial mortgage broker and what do they do? So if you don't know what a commercial mortgage broker is, or mortgage broker period, we basically act as the middleman between the sponsor, which is you, and the lender. And so typically, these are the jobs that we will do. Tell you how your property will qualify, shop around for the best deal, submit everything to your lender, and basically to the lender that we choose, and basically be there with you from start to finish. Prior to COVID, I didn't do, I had my core lenders that I like to use, and I actually still do. But I'll get to that in the end. Now I'm shopping around a little bit more. So I think now more than ever is a good time to be partnered with a good mortgage broker, because you want to know what all your options are. It was always good before, but now I feel like it's critical, because the delta between some of these loan proceeds between the lenders and the rates between the lenders is huge. So it's important to really shop that deal around. And that's what a mortgage broker is here for. So just to kind of cover what are some things a lender will ask. So unlike single family, commercial lending is asset-based. So we don't need to know what your credit score is and what's going on with that. We want to know core things, which is, where's the property located? What is the purchase price? Because to really get the best financing that you can on a deal, you want to make sure your loan amount is at least $1 million or above. Is the property stabilized? Or is it a distressed asset? Is it a value add play, which I'm sure that you all have heard, a lot and hear all the time. What is your experience in multifamily? Can you handle this deal? Who is your property manager? What is your net worth and liquidity? So those are the things that the lender is going to really be concerned about in the very beginning. When I underwrite a loan and you work with me, the first thing I'm going to ask you for that property is the offering memorandum, which is the summary of the property that the broker gives you. That's not going to always be available, especially if the property is off market. But I'm going to ask you for the offering memorandum. I'm going to ask you for the T12 or what you have. We know some of these properties are not managed properly, so we may not have a T12 available. And then I'm going to ask you for a rent roll. And then we're going to kind of talk about what the purchase price is, what your plan is with the property. So we make sure that we structure that loan according to what you need in an actual loan for that property. All right, so I talked about stabilized in the previous slide. So stabilized to a lender is a property that is 90% occupied for 90 days. No major rehab needed and clean financials. And that is considered a stabilized property. You can have a property that's stabilized, in terms of 90% occupancy for 90 days, but maybe it needs $10,000 or $15,000 per door in rehab. Or maybe the seller has been doing a poor job in managing that property. If that's the case, even though it's stabilized from an occupancy standpoint, it's still not where we need it to be in order to get long-term debt. That's still going to be a short-term debt play. A non-stabilized property is occupancy that is less than 90%, low net NOI, which is net operating income. The operations just need positioning. The physical updating or distressed assets, it's, maybe we need a lot of rehab or it's just performing below market. So I kind of put two pictures here so you can see, it won't necessarily be this bad, as this property is. It could look like the first one and still be considered non-stabilized. So just keep that in mind. So I get this question a lot. What is considered experience? What is the lender looking at in terms of experience? So an experienced investor will have 12 months of multifamily ownership and preferably more than one property. So I kind of gave this scenario, and I hate when people read slides, but I need to read this to you. So it says, Jim purchased a 100-unit property in November of 2018 with a non-recourse bank loan. Now John wants to purchase a 125-unit. Jim will qualify for the agency debt because he's now owned a similar property for over a year. Well, Paul purchases a 100-unit property in November 2018 through syndication with other experienced investors, signs on a Fannie Mae loan. Now Paul wants to purchase a 150-unit property, and he can qualify for Fannie because he already has experience. So it gives you a breakdown here. Non-experienced investors in a stabilized property, you would have to go with the bank loan and recourse if you don't have the proper partnership. Non-experienced investors in a stabilized property would have to get a hard money loan. So experienced investors in a stabilized property, we can do an agency loan. We can do a Fannie, a Freddie, a HUD loan. Experienced investors in a non-stabilized property, that's when we get into private money and bank loans and things of that nature. But the biggest difference between the two, as you can see, is recourse versus non-recourse. So I think I have a slide explaining that. If not, I'll jump on that in the end. So this is another question I get a lot. How much net worth and liquidity? So the short of it is your net worth needs to equal your loan amount. And it's the net worth of you and all your partners combined. And then the liquidity needs to be 10% of the loan amount post-closing. So after you've paid your down payment, after you've covered everything, when it's all said and done, you need to have 10% post-closing liquidity. So in this example, a $9 million property, you need to have $900,000 in liquidity between you and all your partners that are on the deal. Yep, I did. Okay, so non-recourse debt. So this is basically the best thing about commercial financing is that there's non-recourse structure built into it. And what that means is there is no personal guarantee. Every loan I've closed has been in an LLC, and the borrowers, the sponsors, are not personally liable. What the terminology that the bank uses is that they have bad boy carve-outs. And people say, well, what is a bad boy carve-out? What does that exactly mean? A bad boy carve-out, the best way for me to explain it is fraud. So as long as you do everything on the straight and narrow path, you're honest about the financials, you're not, doing anything crazy. If this property does not perform and you have to foreclose and you have to give it back to the bank, there's no personal liability for that loan. And you see people borrowing, $10, $15, $20 million with no recourse involved. And so it gives you some kind of level of comfort because you know that you can, take these risks and borrow this money, and it is not going to report to your credit. And if you default because the property just doesn't perform or the plan just does not work out, then there's no personal recourse. Now, one thing I can say in the multifamily world, specifically with agency debt, the default rate is less than 1%. So that's really good because, even through COVID, multifamily has been the best performing asset out there. Collections have been strong. I can't say the same for retail. I can't say the same for industrial. And James knows I work on all asset classes. Multifamily is just my favorite. That's the one that I do the most of. 95% of my business is multifamily, but the small other commercial asset classes I do, multifamily has always performed the best in down markets. So I'll skip over to the next one. So these are other things that the agency lenders are going to consider, and not just agency lenders, but commercial lenders, period. So they want to know who your third-party management is. I know you all know a ton of people who maybe live in California but invest in Texas, or live in Florida and invest in DC. How they're doing that is making sure that they have strong third-party management in place. And that's what the lender is going to look for. I have had clients that, they'll choose a property manager and the lender feels like the property manager is not strong enough. And so we'll have to go back to the drawing board and find another property manager. It's only happened twice, but it just gives you an idea that they really put a lot of weight on the quality of that property manager because they understand, you have other things, you have other properties, you have life, they don't like investors to self-manage. They want you to have third-party management in place. That's what the lender prefers, but it needs to be someone strong. So always vet your third-party management good. When you're looking in an area talk to 2, 3, 4 property managers, try to get referrals. I know James has this group with all these people, you know, post in the group and say, hey, I'm looking at a property and such. Can anyone recommend a property manager? Because the lender does put a lot of weight on who is the property manager. And it could stop funding. So that's very important. U.S. citizenship. So I've had a lot of people ask about this too. So typically on bridge loans, which I'll get to a little bit later, what the differences are with that. But typically on bridge loans, if a borrower, sponsor, key principal, you'll hear me call it, but it's all the same. But if the sponsor is not a U.S. citizen, we can ask for a waiver from Fannie or Freddie. On a bridge loan, they'll, depending on the lender, sometimes we can get it pushed through. The problem with the bridge loans is that those are temporary loans. So when it's all said and done, how do we know that your citizen, that you'll be a U.S. citizen? So my suggestion to investors who are out of the country or don't have citizenship yet is to at least have a green card. If you at least have a green card, you have a strong probability of getting some kind of approval, even if it's temporary. The other thing I want you guys to look out for is the tenant concentrations. So you've got senior concentration, student, military, and employer concentration. So if you're looking at a market like here in Texas, we have Killeen, Texas, where we have a military base there. Lenders typically will steer away, or if they don't steer away, the leverage will be very low, because that means that you could at any given moment lose a lot of occupancy in your property and obviously rental income if it's high military concentration. Same thing with employer. If you're in a kind of a small town and everybody is employed at this steel mill, and that steel mill closes, that could affect you as a property owner if that happens. You know, I think we saw what happened with senior housing and student housing when it came to COVID. A lot of college students are not returning to school in the fall. What do you think is going to happen to those properties? So those are things that the lender will want to know. Those are things that need to be disclosed up front. If you send a deal to a broker and you say, hey, these are some of the things we need to know up front so that we can structure the underwriting accordingly. So just keep that in mind. Okay, so types of loans. So we have bank loans, we have non-bank loans, which are bridge loans, what I talked about before. We have life companies who lend loan money. You have CMBS, and CMBS debt structure is very, very popular for retail asset classes, office, industrial, storage. That is where your CMBS debt comes in. Your agency, your Freddie, Fannie, HUD, and then your mezz debt, which is kind of like an equity structure. You can kind of look at it as a second mortgage, but not really, right? It's a type of equity structure. So the most popular of these for multifamily is obviously going to be the agency, the Fannie, Freddie, HUD, and then the non-bank. Those are the two most popular. Life co companies are great. The interest rates are low. I love life co funding, but the leverage is also low. So when you're talking the best terms, the best leverage, the best rates is going to be your agency or your non-bank when it comes to multifamily. Your bank is just going to be your local banks, your Bank of America, your Chase. They actually do fund multifamily. They do fund commercial, but it is recourse as well. So I'll skip on over to the next one. So in this chart right here, I actually have this in a shareable format that I can send out if you guys want it. Just shoot me an email and I'll send it out to you. But it kind of breaks down your most popular options with your Fannie, your Freddie, your bridge, the experience that you need, the prepayment penalties, if rehab or is or not included. For your Freddie Mac, the one thing, everybody always asks, what's the big difference between Fannie and Freddie? The biggest difference between Fannie and Freddie is that Freddie does not roll in your rehab costs. So if you look at this chart where it says Freddie Mac and you go down to rehab included, it says no. So they will roll in closing costs of 3%, but they will not roll in any CapEx, and Fannie Mae will. So those are the two biggest differences between the two. Obviously, with the bridge, yes, you're going to have that, but this just kind of gives you a breakdown of the different loan types that are available and what's the biggest difference between those loan types. Your bridge loan is always going to be your temporary loan. It gets you from purchase to stabilization. When you have a CapEx budget that is over $5,000 a door, or even if your CapEx budget isn't large, but the property is not cash flowing, remember we said the NOI was distressed, then we're going to use a bridge loan in that scenario. So this kind of breaks down all the different types of loans that are available for multifamily and the differences between those loans. So it's always good to kind of have this handy. So how does the lender underwrite? This is very, very important because a lot of investors think that they're going to take the pro forma income, so the projected income of what you're going to do with that property once you have ownership. But actually on permanent debt, we're going to underwrite in-place income, usually T3 or higher. So in most instances, obviously, we don't have June yet. So let's just take this month. On the deals that I'm underwriting, I'm using March, April, and May. And I'm going to annualize that number, and that's going to be my income number. And then you're going to tell me what your projected expenses are for the property. So if you think about it, your expenses can't possibly be the exact same as the seller. You're going to have a different property manager. You're going to have a different budget. Things are just going to be different for you. So we're going to take your budget that you have, your projected budget, and usually you can get that from your property manager. And then we're going to take in-place income, and we're going to come up with what that NOI is. On bridge debt, however, we're going off of pro forma. What are you projecting for the next 3 or 5 years for your income to be, and what are you projecting your expenses to be? So keep that in mind when you get a deal in that you're underwriting. If you want to try to put it under permanent debt, always use in-place income and pro forma expenses. If you think it may fit better on a bridge, then pro forma income and pro forma expenses. So that's really important to keep in mind. So if you've never closed a deal before, even if you have closed a deal before, so many people are curious about what happens. So I'm under contract, now what? So I always tell my investors, call me first. So before you put that LOI in to the broker, call me, let me underwrite the deal for you and tell you where the financing is going to shake out. If there's something hairy on the deal, like we talked about with the student concentration, or maybe there was a murder at the property, or if there's anything that's questionable, we're going to address it up front, and we're going to give you an idea of what the financing will look like. That is really going to help you going into that contract, because you'll know exactly what you need to offer. It kind of helps you with your offer. If you say, okay, well, the seller doesn't have all their documents, so can you give me a list of the documents that I'm going to need? I'll send that over to the broker and see if the seller can produce it. Because if the seller can't produce everything we need, even though the property is stabilized, even though the CapEx is low, we still may need to do a bridge. So those are just some things to keep in mind. So hopefully you contact a broker prior to going under contract. And then this is what the timeline looks like. So once you get the property under contract, you start your due diligence process. That due diligence timeline is negotiated between you and the seller. Some people do 30 days, some people do 15 days. So it really just kind of depends on you and what you're able to negotiate. Then after due diligence is done, then we start the loan. So we do not start the loan process prior to your due diligence period ending. We may get a term sheet and we may update those terms throughout that due diligence process. And we're kind of finding, we're shopping, I'm shopping it around, I'm getting you quotes, and before the due diligence period ends, we're going to sit down together and we're going to go over what the best terms are that we got, and you're going to plug that into your underwriting. You're going to see what type of returns you can get off of that property. Then we'll move into the loan app. And the reason why is because the lenders, Fannie, Freddie, Bridge, they all require an application deposit. Those application deposits can range anywhere from, say, $8,000 to $50,000. Seriously. So it depends on how many units you have. It depends on the terms and which agency or bridge or what have you. But once the lender receives your application deposit, then they order third parties. So you don't want to start the loan app prior to the due diligence period ending, because if you end that contract, then you've paid for appraisals, third parties that you don't even need. So we wait until due diligence is over, then we move forward with loan app and deposit. Then we move to third parties being ordered. And then we have another due diligence, but this is lender due diligence. So this is collecting your personal financial statement. This is personal financial statement, schedule of real estate owned, a short real estate bio from you, and any other documents that we may need. So on a personal financial statement, you'll have your bank accounts listed there, but I'll also need to collect 60 days of statements for each bank account that you have listed on your personal financial statement. There will also be some documents that the lender will say, you'll need to have those filled out. For me, I always do everything for my clients. So I'm filling out everything for you. I'm sending it over to you for review, because filling out those papers can be super daunting. I've done it thousands and thousands of times, so I know exactly what information needs to go where and what needs to be left blank, and then you can review it and then take it from there. So it makes the process a little bit easier, and you can focus on your equity raise. Once we've collected all the documents, then we go into credit review with the lender. And at credit review, it's basically just making sure that all the documents have been received, that everything looks good and put together. The lender will issue the commitment, and the commitment will need to be signed, and then we will rate lock, and then we will close. So that is the process. And so on agency debt, we need 45 to 60 days for a closing timeline. Right now it's a little bit longer, but I'll get into that later. But 45 to 60 days for closing on agency debt, and for bridge debt is 30 days or less. It's a lot quicker process. So let me move on to the next one. So I've got let's talk market. So I know some of you have probably heard this. You have your primary market, your secondary market, and your tertiary market. And what does that mean? So in layman's terms, a primary market has 5 million or more people, a secondary market has 2 to 5, and a tertiary market has 2 million or less. That's what that is. And so when you hear primary, secondary, tertiary, some of these tertiary markets, the lender may have lower leverages because the market is so small. They don't want to give you 80% on a property that's in a tertiary market. It's a smaller market. It's a higher risk to the lender. So that's what that means. And so I've actually pulled the top 25 MSAs, and MSA stands for Metropolitan Statistical Area. So these are the top 25 MSAs in the U.S. So I know some of these, obviously everything looks familiar to you, but Dallas is number 4. That's where I am. Chicago is where I'm from. So that's number 3. But yeah, when you're looking in these markets, not to say to not step out of these markets. It's just when you're in the major MSAs, your terms will be more favorable. When I was doing single family loans, we had this thing called redlining, where the lender could not say, we're not going to land in that market. Well, on the commercial side, they redline. And for them, it's like, okay, we're either not going to land in that area, or if we do, the leverage will be lower, the rate will be higher. So it just kind of depends. And this changes all the time. So I'm going to go on to the new rules, the things that have changed during COVID. So we've got a lot of changes that happened during COVID, but one thing I can tell you, bridge debt there are still some bridge lenders that are lending, but they've kind of paused for the moment. Agency debt is still going strong, and that's because they're mandated to fund during these times. That's what they're there for, to inject liquidity into the market, no matter what's happening. So one thing that they've done is they've lowered the LTV. So you can pretty much, I like to do conservative underwriting and not aggressive underwriting. So when I underwrite a deal now, depending on the situation, the property, I'm underwriting that property at 75%. Now, you can still get 80%, but the lender is looking for sponsor strength. They're looking for high net worth, high liquidity. So think about strong partnerships. So where you really only need 10% post-closing liquidity, your net worth needs to be equal to your loan amount. But how about let's do over what we need? So then maybe we can get a higher LTV, and maybe we can get some of the reserves reduced, which I'm going to get to next. The next thing that the lenders are doing is they're requiring reserves. So a lot has changed with the reserves over the last few weeks. They've actually gotten better. So with me in underwriting a deal, if it's under $6 million and it's a Fannie play, then we're going to do 18 months reserves. If it's over $6 million, whether it's Fannie, Freddie, or what have you, we're going to do 12 months reserves. Bridge loans are not really requiring the reserves, because sometimes on bridge loans you need reserves anyway, but they don't have mandatory guidelines like the agencies did and said, okay, well, we need 12 months reserves or 18 months reserves. So let me explain what those reserves are. Those reserves are now just principal and interest for 12 months or for 18 months. And it goes into an account with the lender. It's not rolled into the loan. So that is additional down payment that you will need. It will go into an escrow account. And if at any point you need to pay your mortgage payment from the reserve account, it's there for you to use. And they're using this because of the uncertainty with COVID, and because they understand that your occupancy may drop, your collections may drop. We really don't know how things are going to perform and if we're going to have a second wave, so they're wanting these reserves in place. Another thing I want you all to think about is the longer closing times. Now, obviously, like here in Dallas, we're pretty much everything is open, pretty much. But there are still some areas that are closed. So if you have your recording offices that are closed, or the appraisers have had to change the way that they do inspections, the engineers, they've had to change the way that they do inspections. They're actually doing a lot on video, and they're not going into every single unit like they used to, or as many units as they used to. So sometimes, there are so many people involved when it comes to getting one of these commercial loans done. We have to be considerate of maybe we'll need a little bit extra time. So when you are negotiating your closing time in your contract, just make sure you get extra time. I'm telling everybody that. Just make sure you get extra time. Every single loan is pre-review. So the lender, I may tell you, hey, we can get 75% on this. Once we submit everything to the lender, the Fannie or Freddie, they're going to review every single loan. And they did not do that. They did not do that. But now everything is pre-review. And then we have to get their blessing, prior to us moving forward. When it comes to waivers, pricing discounts, and longer interest only, everybody says, oh, can I get 5 years IO on this? Well, I don't know if we can. So when we're underwriting, we're going to underwrite it with 1 year. Unless it's a Freddie loan, then we can underwrite with 3 years. But we're going to underwrite with 1 year, and then we're going to go in and we're going to ask, and we're going to say, okay, here's our sponsorship, here's their financials. And, can we get better pricing? Can we get pricing waivers? Can we get a longer IO? So those are things that we have to go in for waivers for. One thing I know that, a lot of investors were doing anyway was raising additional equity prior to COVID anyway. But raise additional equity when you're doing this. You want to make sure you have some cushion in the event that things change or things go wrong, or no matter what happens, you want to make sure you have a little bit more. So maybe raise 10% more than what you're budgeting for. You always want to have that cushion. And then when you're working on your pro forma and your projections and you're preparing your PPM for your investors, you want to be very, very conservative on that year one projection. So a lot of lenders are calling 2020 to 2021 the year of zero. So if you underwrite year one as year zero and just say, okay, we may not be able to do rent bumps when we first do our acquisition, maybe 6 months down the road, maybe 12 months down the road, maybe we can bump the rents then. Even if it's a rehab unit and you have a $100 rent bump, planned on that particular unit, maybe you can only do 75. We really don't know, but you want to be conservative. Even if you can hit those numbers later, be conservative going into the deal. I know some investors are also delaying distributions for their passive investors. So if we're calling it the year of zero and we really don't know where rent bumps are going to be, can we delay those distributions to the investors? Will your investors be okay with that? So kind of think about that as you prepare your packages, prepare your PPMs, and when you're underwriting these deals, you want to make sure that you're being conservative all the way around. And then obviously call a professional for help. Call me. I'm here. I can help you tell you which way you can go, or share with you other clients' experiences and how we've navigated through those issues. So it always helps to talk to a professional. I tell everybody to stay off social media, because I have so many clients that, they'll screenshot something and they'll say, oh, is this true? And I'm like, no, don't listen to it. It's not true. But, everybody thinks, that they know. So talk to someone who really does, so that they can help you. And just keep in mind, this is not a real estate crash. There are still some great deals out there. I have been super, super busy the last 6 weeks. It's just been crazy. So there's still some really good deals. From the broker side, from the investment sales side, they're really not seeing a dip in pricing, maybe about 10%. But one thing I can say, the sellers seem to be a little bit more, they're willing to negotiate a little bit more than what they were before. So just keep that in mind. So this is it. So we can open up the floor for Q&A, James.
Awesome. So that was awesome. Thank you very much, Brandi. That was really great information. I'm sure people got a huge amount out of it. So I've been writing down some questions as people have been asking them. And then I wrote down a couple of things that I thought maybe people would be interested in that maybe haven't asked them. So I'll go through those first. And as I'm going through those, if you guys have specific questions that you want to ask now, go ahead and put them into the chat box, and we can go from there. So so I guess this is kind of an order of things that when you talked about them. So one of the things somebody asked was, how does a sponsor or KP prove their financials if you don't ask for a credit report? Do they ask for taxes? How do they go about doing that?
Yeah, so normally twofold, depending on the type of financing we do. If we do agency financing, they do not ask for tax returns. Bridge financing, they usually will ask for tax returns. But what they're doing is you fill out a personal financial statement, and my investors that are very active in the market, they have their own financial statement, and it's updated regularly. They sign it and date it. That is you confirming and stating this is where your assets are. Then we're collecting the bank statements to prove this is how much you have in your 401k, this is how much you have in your checking, and that's it. Now, they do pull credit. I don't pull credit. The lender pulls credit further down the road. They don't pull it in the beginning. And again, it's a collective thing. We kind of know where we need to be. If you think there may be some things on your credit and you have some questions about that, and I've had that in the past where my client filed bankruptcy, but his his credit was restored and he was back to normal, the application will ask you, have you filed? Okay, so you will kind of give us an explanation on that. So just remember, this is all about partnership. It's not necessarily wait on one person, but that is how we do it. Personal financial statement, bank statements to back up whatever we put on that personal financial statement. Now, obviously, you're going to list your life insurance and personal property and your home and other properties that you own. We're not verifying that information. And this is where the bad boy carve out comes into play. Because if the property defaults and it doesn't perform well, then they're going back and they're looking, okay, well, what did they say their net worth was? Well, we need to verify that, So that's where the honesty comes in and all that good stuff. But yes, it's definitely not like single family. So credit reports come later.
Okay, great. Thank you. A couple of other questions. Clean financials on a property when you're evaluating it. What does that mean?
Okay. So that means that everything is documented from the seller. So a lot of times a seller will self-manage a property and they have no idea that all the expenses need to go in, and they can't take expenses from another property and put it into those financials. So when I say clean financials, it just means that everything is recorded, documented, and available to us. That's what that means. But in a lot of cases, it's not. I mean, I just closed a Freddie loan for a client about 2 years ago, and they hired a PM who didn't put all the CapEx dollars into the financials. And it was a lot of things that he left off, not just the CapEx dollars. So when we went to go back and look at it to do a supplemental on it, the financials were wacko. It didn't work. It didn't work because everything was not documented, and we had to wait 6 months before we revisited it again because he had to fire him, hire a new property manager, and get everything else in order. So that's just what it means. Clean, documented, everything there, and everything available. Because you'll see this too, where people will have a property and they'll say, oh, well, we only update our financials once a year. So it's like, okay, well, what about May or June or August? They don't do that. They do once a year. So readily available monthly financials. That's what I mean by clean.
Okay, awesome. Thank you. This you answered half of it already, but they were asking about what are standard LTVs, which you kind of touched on a little bit. What about rates now? What are rates looking like for Fannie Mae, banks, that kind of thing?
Absolutely. So rates are actually really, really good. Really, really good. The thing is your best rate is going to come with a higher loan amount. So a lot of the rates that you see advertised, like the 2.75, the 3%, yes, that's real and it is definitely available. But that is for loans above 10 million. The typical rate for something under 10 million, depending on the location, depending on the term, I'm going to say you'll be somewhere between 3 and 3.75. So the rates are still great. Yeah. Now on bridge loans, I mean, gosh, you guys, I closed a bridge loan right before COVID and we were at 4.63%, I believe. And bridge loans now are 7 to 9%. So that's a huge delta there. But when you're talking agency, yes, rates are still great. HUD rates less than 3% as well.
Wow, that's awesome. You touched again a little bit on this. So reserves encompasses, and I think you mentioned it's principal and interest, correct? It goes into an escrow account?
Right. Prior to a week and a half ago, it was more than that. But right now, it's just principal and interest.
Okay. And that is funny as a question I would have asked. Do you get interest on that amount of money? Do they pay you interest?
I wish, but no.
All right. The other one is if someone is asking for IO for 5 years, 4 years, whatever it may be, is that a red flag to a lender since so much is dependent on the sale or refinance on the back end?
So no, what is very, very typical. Okay. A couple of things. You want to have a loan amount, I'm going to say above 7 or 8 million if you want to ask for that much IO. Typically, smaller balance loans, 3 years is like your max. but you will get your highest IO with the longer term that you take. So if you're asking for 5 years IO, the lender is probably going to tell you, hey, you need to take a 12-year loan in order for us to give you that much IO. But it definitely does not raise a red flag. The lender understands that you need that cash flow in the beginning. So it does not raise a red flag.
So before somebody posts this, because I know it's going to come up, if someone wants security, why would they give you a 12-year loan? Wouldn't they feel more secure giving you a 5-year loan in case interest rates change?
So the way they're looking at it is, so I didn't talk about prepayment penalties. I guess I should add that to the slide. So, so every commercial loan, most commercial loans, I don't want to say every, but most commercial loans come with a prepayment penalty. And you have a yield maintenance prepayment penalty and you have a step down prepayment penalty. Yield maintenance it's hard to calculate yield maintenance because yield maintenance is determined. Yield maintenance says, okay, if you have a 12-year loan and you pay it off in year 5, you're going to pay us interest through year 12. But it's also calculating where the bond is pricing at that time. So it's super hard to determine what a yield maintenance prepayment penalty. If you ask me, I have a yield maintenance calculator and I can give you a range. That's it. I can't tell you exactly. Then they have step down prepayment penalties where it's a percentage, and the longer you have the term, the shorter that is. So on a 5-year loan, the prepayment would be 5% in the first year, 4% in the second year, 3, 2, 1%. So the lender looks at it like this. If you take out a 12-year loan, you're not going to refinance, right? You may sell it on an assumption. You may get a supplemental on it to pull out additional cash, but the odds of you refinancing it because the prepayment penalty is so much, or the odds of you selling it is so high. And I know you all probably have been seeing a lot of assumptions lately. And that's because properties that were acquired, 1, 2, 3 years ago, they still have a hefty prepayment penalty on them. So that's how they structure it. I'll give you a longer term. I'll give you more IO, but you're going to take this prepayment penalty.
Okay. And then after year 6, it goes away?
After year, yeah, exactly. But that's if we're in a 5-year. In a 10-year, it's like 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. So yeah, and sometimes they'll give you some flexibility on how to structure it when you go with the 12-year, like maybe cutting your prepay just short of 12 years.
Okay.
Yeah, so you have a little bit of flexibility.
Okay. We might need a slide on that.
Yes, I know. How did I forget that? I need to add that in there.
This one's a kind of a gimme, right? What does T3 mean? Is that debt? What does that actually encompass?
Yeah, so T is just for trailing. That's what T stands for. So the broker will usually, the broker or the seller will prepare a trailing 12, and it's a breakout of the income and expenses of that property for 12 months. But instead of taking the entire 12 months, I'm going to take the last 3 months, which would be the trailing 3 months, and calculate income based on that. So that's what that is. So especially right now, some of our lenders are saying, hey, underwrite to the T1 because that's really accurate because it's the last 30 days during COVID. How did the property perform? But your T3 is looked at as your most accurate income, for that moment. So yeah, so that's what it is. Trailing financials, trailing 12 months, trailing 3 months. That's what that means.
Okay. And then will they look at T3 expenses or will we look at T12 expenses?
So it depends. If it's an agency debt, regardless, we're looking at your expenses. I never calculate what the current expenses are. I don't use that in my underwriting. Now, we do look at them, right? And if something seems off, we kind of use the seller's expenses as a guide. So, for instance, if I'm underwriting water at $50,000 and the seller has water at $80,000, okay, well, what's happening? What's different? why are you projecting 50 and the seller has 70? Where's the delta in that? So we look at it, but we don't calculate it from the seller. We always use your projections. And just so you guys know, this is a little tip, but further down the road, at the end of the day, the appraiser is the one who determines the expenses. So once we can have a budget from the PM, and usually the budget and the budget from the PM and the appraiser are pretty close, right? But there may be a difference between the two that maybe we need to push back with the appraiser. Well, no, here we have documented proof that this is what this expense will be, and we can kind of push back on it. But the appraiser is the one who determines the final expenses, and he determines it based on market. And that's what the lenders want to see. What is the market determining? So I've had situations where my clients were able to negotiate a 3% property manager fee, but the market was 5%. Well, the lender made us use 5% because the lender is like, okay, well, what if he drops the ball? What if he doesn't perform? And then now you're out looking for a property manager and it's going to go up to 5%. So we need to calculate that in the beginning.
Okay, great. Out-of-state brokers that are in the market where you're buying, is one better than the other? Does it matter?
So I land nationwide. I have a ton of clients here in Texas. Not many of them purchase here in the Dallas area per se, but the southern states, it's really hot right now. Some of the West states are really hot right now. But no, I've funded in probably about 15 states so far. Yeah.
Okay. Another question, supplemental loans, Freddie, Fannie, what does that mean? Who gives them? That kind of thing.
Okay, so think of a supplemental loan as a second mortgage. Freddie's small balance, so that's loans under 7.5 that are funded with Freddie, you cannot get a supplemental loan on. So if you own a property for a few years, you've rehabbed that property and you don't want to pay that prepayment penalty, then you can take out equity out of the property by using a supplemental loan. If you assume a loan, so any Fannie loan, no matter the loan size, can have a supplemental loan on it. The minimum loan amount is $1 million on the supplemental, and it's basically a second mortgage. It's used to pull out equity of the property without having to refinance it. And supplemental loans are coterminous with the first loan. So if you're 3 years into your first loan and you've only got 4 years left, then that supplemental loan will be coterminous and it will balloon with your first mortgage payment, with your first mortgage loan.
And I'm sorry, Fannie Mae is the only one that does that, supplemental loan?
So Fannie Mae does it and Freddie does it on loans above $7.5 million.
Okay.
Not available for bridge because remember, bridge is temporary anyway. It's a short-term loan.
Okay. And then I'll just read this one because it was too hard to actually write down. Is the yield maintenance equally as common as the step down, or both typically in agency debt?
Yes, both are. So on bridge debt, you're going to have usually a 1% exit fee. That's a 1% prepayment penalty. Step down and yield maintenance are both popular. The lender gives you a pricing discount on the interest rate if you take the yield maintenance. And sometimes it can be as much as 20 basis points between a step down and a yield maintenance prepayment penalty. So it's an incentive in the rate to take a yield maintenance. But if you want to have flexibility over the long term, then you want to go with the step down and maybe just pay that extra, 20 basis points. But I always tell everyone, structure your loan according to your exit strategy. You want to give yourself more time than what you think you may need, but also you don't want to be stuck in a loan if you're planning to sell in year 5 or year 7, and now you have a 10-year loan. Maybe a step down is going to be better because if you know you're going to sell in year 7, you've given yourself a little cushion by taking out a 10-year. So you've got 3 extra years, but then let's do a step down because in year 7, I can make those projections. I know exactly what my prepayment penalty is.
Okay, great. And then another one was, when you do your personal financial statement, your LLCs that you have property in, how do they, if I understand the question correctly, how do they value that towards your net worth? Is it, I own 20% of the LLC, therefore I'm going to get 20%, or hey, I'm part of this LLC, so the whole thing goes towards my net worth?
Yes, it's calculated on your percentage. So it is calculated on your percentage. And I'll touch on businesses too. So any properties that you own is in an LLC, you would list that property under your schedule of real estate, and it breaks out the schedule of real estate that the lenders like to see are very, very detailed. They're not compressed at all. So it will break down what your actual percentage of ownership is line by line, by property. When it comes to businesses, because I know a lot of you also own businesses, that can be counted on your personal financial statement too. For every business that we list on the personal financial statement, if you have a business account, let's say you have $50,000 in this business account, but it's you and one other partner, then the lender is going to ask us for the legal documents to that particular LLC so that they can see what percentage you own. And if it says that you own 50%, then they're going to take that number from 50,000 down to 25,000, because that's how they're going to calculate that particular line for that checking account. If you own 100% of the business, then they're going to give you that whole $50,000. And those are on businesses.
Okay, great. A couple more here. You kind of touched on this, but are you seeing lenders, maybe not so much Freddie Mac and Fannie Mae, but are you seeing lenders in general opening up more since COVID hit, or are they being much more reticent?
So on the bridge side, well, yeah, let's not talk about, because we already told you Fannie and Freddie are lending. But on the bridge side, when everything happened, so bridge and CMBS, we talked about the commercial mortgage-backed securities because CMBS encompasses a lot of retail. And you know what happened with retail? It shut down. So on another type of loan is portfolio loans. So if you own multiple single family homes and you want to put them into one loan, that's considered a portfolio loan, and that is considered a commercial product. I also fund those. I have 4 lenders that fund portfolio loans, and when COVID happened, all but one shut down. And when I say shut down, I mean pause lending. So not closed, but pause lending. Most of the bridge lenders paused lending. Most of them did. CMBS shut down. So now, as of last week, CMBS is providing term sheets now. So they're projecting that if they provide the term sheet now, in 60 days, they'll be ready to fund again. So that's great. The portfolio lenders that I spoke about, they just started funding again within the last 2 weeks. So that's good. So I'm seeing everything come back in line now. And I think that also attributes on the multifamily side. Part of that reason is because even though we had one whole quarter, end of June is one whole Q2 was all COVID, and rental collections were still strong. So they see that now. And so now they are feeling a little bit more comfortable about moving forward.
Okay. And then are non-bank loans the way to go for newbies? If not, then what would you recommend?
So no, what I would recommend is to partner with someone who has experience doing an agency, or you can do non-bank. You can do the bridge loans because the bridge lenders don't mind first-time buyers. And actually, Freddie is more, they have more flexibility with Freddie with first-time investors as well. So I was able to close a loan for a client last year. He owns some smaller multifamily properties, and I was able to get him his first agency loan without having any agency experience prior. But he owned multifamily. So even though he didn't have, agency experience, he had experience in the business.
Okay, great. And I think we covered everything. If you guys have another question or something like that, type it in now. So Brandi, thanks so much for doing all this. We appreciate it. I see on the bottom left, I think, is your email address, Brandi at renocm.com.
Yes, yes.
Okay. Hopefully everybody you can see that on your screen, right? So everybody else can see it?
I think I can see it on my screen. Hold on. I see it up somewhere.
Do you want to type that into the chat box for everybody?
Yes, let me do that. And I'll stay on. I'm going to stay on and talk to you guys. So come to the chat.
All right. So we're going to go ahead and do the networking.